Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Happy Wednesday, everyone. Welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals and precious metals investing. If you're new to the show, thank you for joining us. You can find all of our previous episodes on either the ANCAP Radio Twitter page or the SWP YouTube channel. If you've been here before, thank you again for your support. While you're over on the YouTube channel, make sure to check out our Inside the Vault series, which is one of the most viewed channels about precious metals investing on the web. We're incredibly excited to expand Inside the Vault into podcast form with ANCAP Radio. So thank you again to ANCAP for hosting us. I'm your host, Jeremy Barlow. I'm excited to be with you today. We've got a great show in store. We're joined by Luke Staden of Blacktower Financial Management, who will join us in just a moment. But to kick things off, we've got Mark Yaxley with us as always. Let's turn it over to him for the weekly market update. Mark, it's been a pretty wild week in the metals world.
Hey, Jeremy. It feels like we say that every week, but I think this one, takes the cake. Really dramatic trading session on Monday, starting Sunday evening with the Asian overnight market. We saw gold up about $90 an ounce. There was a report that a U.S. warship had been attacked in the Red Sea, which later turned out to be a somewhat false story. In fact, it was just aiding two commercial ships that had been attacked by drones there, but that drove the price up dramatically overnight. And then only to see it come all the way down and close actually 2.5% down on the day. So one of the wildest days in gold trading that I've seen in my 18-year career. Obviously, you still have the latest gold rally that's being fueled by speculation that the Fed is going to start cutting interest rates as early as March of 2024. That's kind of really the anticipated moment for the gold market right now. Fed Chairman Jerome Powell did say on Friday, and this is worth noting, that it was premature to speculate when policy might ease. Core inflation is still well above target, he said. So he's still, speaking somewhat hawkishly about the possibility of rates being cut. He's not committing to a date when that might begin. He repeated that the Fed would raise rates until further if necessary. We still have two wars. Grinding really is probably the right word to say. You've got the war in Gaza that's, resumed after a week of ceasefire. The war with the Ukraine continues to grind on, Russia and the Ukraine pretty much at a standstill. But what that is doing is creating a floor from a geopolitical risk position as it ties into the gold price. There was an interesting comment made actually by the Office of Management and Budget, where the director of that office delivered a letter to U.S. Congress stating that the United States is, quote, out of money to support the Ukraine in this fight. Certainly a development worth watching. They said basically beyond the end of this calendar year, they're not going to be able to support the Ukraine at the level that they have previously. So interesting to see how that war might change or escalate once funding dries up from the United States. Despite gold's pullback, I'll finish on this. Despite the pullback that we've seen in the last 24 hours, really important to note, a lot of people pay attention to these kind of things. November was the highest ever close for gold. It closed at $2,040 US on November 30th. That's the highest ever. The previous high was just under $2,000 in April of 2023. So that's a good indicator for gold going forward. And right now, I think what we're seeing is a period of consolidation. We've hit the all-time high for the gold price. Obviously we've seen a pretty big pullback, and I think investors are just waiting to see what is going to come next, and maybe a little bit of stability in the gold price is a good thing as people reestablish what they want to do next with their gold and silver investments.
Thanks for that, Mark. Yeah, an interesting week to cap off, which was an equally interesting month across the board for investors globally. I want to bring in our guest who can help us make sense of it all. As I mentioned, Luke Staden joins us today. Luke is a former stockbroker turned international financial advisor with Blacktower Financial Management. Luke, welcome to the show.
Happy to be here, guys. I'm very excited. Love talking about international financial markets.
Well, let's dig into it. Before we do, we always like to open by giving our guest an opportunity to introduce themselves to the audience. As I mentioned, you're a former stockbroker turned financial advisor. You've also got a passion for education, it seems. Tell us a bit about your career path, maybe shed some light on the key differences between a stockbroker and a financial advisor.
Well, the role I had as a stockbroker was actually quite a niche one. While we did the standard brokerage services, such as people want to trade on the FTSE 100, which is or the FTSE, or the London Stock Exchange, we would input those trades, give advice. My real area of focus after a few months and being promoted to this position was to go to roadshows for companies trying to IPO on the smaller AIM market, which is the alternate investments market. So my job really was to go into a room with a CEO who's trying to raise money for their company and ask him a load of tough questions to see if he's worth bringing in front of my clients. So being a stockbroker, though, is very focused on day-to-day trading or day-to-day investments. The time horizon for how long you're going to invest for is, it can be anywhere from days to weeks to months to years. Typically with the IPO space, you always tell the people who are trying to raise money from you that the time horizon is for years, but often people want to sell on the open. From there, actually, it wasn't a straight transition. I worked as a prime broker for a while, but missed the client relationships I had on a stockbroker. Because when you're a stockbroker, you're speaking to people who you're trying to make money. And when you make them money, there's a certain level of gratification there. With the prime brokerage, you're just speaking to hedge funds who are very lovely, but you don't feel quite as good, I suppose. But the reason I transitioned into being a financial advisor was actually one of circumstance, because my partner had to leave the UK following the Brexit vote. Her visa was cut short, and she had to move to the Netherlands because she's not a UK citizen. She's a Chinese citizen. So I just found the first job in finance I could that would let me get as close to her as possible, which led me to international financial advisory firms. Now, the difference between an international financial advisor or just a financial advisor and a stockbroker in general is a stockbroker is essentially pretty short term. I'm trying to make you as much money in a short period as possible, and it's just about making money, really. With a financial advisor, my job is to understand what your long-term goals are, rather than trying to invest for anywhere as short as a day to a week. Really, I don't see clients unless they're willing to invest for at least 5 years or more. So long-term goals, such as buying a house, investing towards your retirement, or building up enough money to send your kids to school, are goals that we try to plan for. And it's not short-term individual investments such as individual stocks, but it tends to be a combination of different ETFs or active mutual funds, if that takes your preference, to get our clients to a long-term goal. Honestly, I really enjoy it because goal targeting and goal setting are really important in individuals' lives. And also between you and me, and I suppose your audience, it's a lot easier to get right, because when you have a 10-year bet that you're investing in the stock market and it's going to go up, that's a lot easier to hit, as the stock market tends to appreciate, at least if you look at large caps in the US, by 10% per year, as opposed to a very short-term bet in the stock market, which can make a lot more money on a short-term basis, but has more chance of failure.
Yeah, I mean, I feel like we reiterate this every week on the show, but the old adage of time in the market is better than timing the market, and that is proof right there. I wanted to talk a little bit about Blacktower very briefly. You offer a range of financial planning services, from investment, retirement, and protection plans. What are the key differences in those offerings that you provide for your clients?
The key differences for Blacktower versus competition, or the key differences for our offerings in general? Because our offerings in general differ based on the need of the client. For example, I'm actually very proud to work for Blacktower because we're one of the very few financial advisory firms outside the US who have the permissions to manage American investments and 401ks back in the US, which is just, if you're not an American outside the US, you won't understand why that's a big deal. But if you are, you understand that essentially being an American expat is the hardest person to be when it comes to investing, because most banks and most firms don't want to touch you because of FATCA fears. You're having your accounts closed in the US because they don't want to touch expats. And that even extends to 401ks and IRAs, which have huge penalties for exiting early, but you don't often have that choice. But the most common investment that we tend to do tends to be retirement planning, because that's something that everyone has to do. And with an aging population and a decreasing workforce, as the birth rates have been slashed by almost half, pretty much across all countries over the last 50 years, it's becoming more and more focused on the individual to have a personal plan to fund themselves in retirement, as previous systems of state pensions and previous employer pensions aren't nearly as generous as they used to be. And many state pensions are considered to be at risk, especially if you think about the fact that every year they raise the retirement age across several countries every year, because it's really expensive to the governments to continue funding these plans.
Right. And you mentioned something interesting there about expats. I've seen your conversation recently with the International Advisor on YouTube. I wanted to touch on that just a little bit. A significant part of our audience is made up of expats and those that are multi-jurisdictional. What are some common issues that these people face? Those that don't necessarily have roots in any one country. What do you see and how do you help these people out?
Excuse me. Well, one of the things which expats should consider when using financial advisors is that when you have a financial advisor, you tend to want to have that advisor, if they're good, for life. You develop a plan for every stage of your life. But if you do it locally, well, a lot of the time it's going to be in a language you don't understand, but expats tend to move around. Every time I move to a new country, which there have been 6 in total, I think this is the country I'm going to stay here forever. But by and large, statistically, expats will move from country to country. So one of the benefits of using a service like Blacktowers is that we have licenses across the globe. We have offices across the globe, so that when an expat moves from country to country, the same advisor can follow them and lean upon the multi-jurisdictional knowledge of other advisors in those countries. Being dual regulated and having an understanding of multiple different countries' rules and regulations on investments allows us to plan long term across all countries rather than just the short term of where you're based in.
That's great. Thank you very much for that, Luke. I want to dig into the current state of the markets. Obviously, Mark just went through his market update. I'd love to get your thoughts on the current state of affairs right now. As we talked about just before we came on this call, November was a very impressive month across the board. S&P at 500 just came off of one of its best November months in a century. The NASDAQ is up, gold is up, crypto is up. It seems like every asset class, and you mentioned this yourself, everything is up across the board. This is, in spite of an uncertain interest rate environment, geopolitical tensions are high. Some people still talking about recession in 2024. Few anticipated this kind of an end to the year. How are you making sense of everything that's going on right now?
Well, I'm not actually particularly surprised by what happened in the last months. To be honest, personally, I've been thinking it's going to happen for several months beforehand, almost last year perhaps as well. This year seeing a rally at this time isn't actually that unusual if you consider the fact that last year was a negative year in the markets. And historically, statistically, although there's correlation, but there's definitely not causation there, you tend to see large bounces the following year. The reason the markets are doing so well right now, the reason bonds are going through the roof, the reason that equities are going through the roof is because in an interest rate uncertain market, the market's betting on interest rates being cut. They're definitely betting on interest rates not rising. Because what happens when you raise interest rates is you increase the cost of borrowing money. So that means that people are less likely to take out mortgages to buy houses, less likely to take out overdrafts to buy luxury goods. And companies are less likely to borrow money to fund research and innovation or marketing or whatever it could be, and so are governments. So when you cut interest rates, that means that everyone suddenly got access to cheaper debt, cheaper money, and the money supply tends to increase, spending increases, and that tends to be very positive for companies because people are buying more stuff, they're going to have more revenue. It's also good for bonds because all of the existing bonds are currently yielding very attractive returns because they are based on current interest rates. So when interest rates are cut, if they are cut, that means the next group of bonds are going to be paying less than the current bonds on show. And that means that these bonds were even better compared to the new crop of bonds, and their essential price should increase to balance out the yields. But that's kind of the short-term view on the market. As that's probably what I'd say as a stockbroker. But as a financial advisor, if you let me, I'd like to give you a more long-term view. And to get to get there, we kind of have to have quite a lot of context as to how we got here in the first place. So in 2007, 2008, we had the great financial crisis, and countries and central banks across the world slashed interest rates, cut them down massively, and also took out a policy of quantitative easing. So they would buy company bonds, government bonds, and just inject a load of money into the bond market. So they reduced the cost for governments and companies to borrow money, and then gave them all the money that they needed that they wanted to borrow, which essentially is why bond rates have been, up until a few years ago, very, very, very low for over a decade. Now, normally what happens with quantitative easing is when you inject this much money into an economy, inflation is going to increase because there's going to be more money circulating for the same number of goods. And if there's more money competing for the same number of goods, that's going to push the price up. That's what inflation is. But all of this money went to the rich, the companies, the governments. It didn't really hit your man on the street. So demand inflation kind of didn't increase. And it didn't really increase until COVID, when everyone was locked inside. Governments started spending loads of money just making sure people had enough money to eat, and that hit the consumers, which had a bump in inflation. Then we had the war in Ukraine, which is my takeaway as the biggest cause of essentially a lot of the mess we're in now. Not to mention, just a keynote here, just move past it. COVID messed up a lot of supply chains, made it harder to get goods around the world. It put barriers into international trade as demand and trade slowed. So that in itself, when it costs more because it's harder to do it, to get goods from one place to another, that's another cause of inflation. But the war in Ukraine is a huge part because most of the inflation has been concentrated around energy bills. So, and that's largely brought on by the fact we just started sanctioning Russia, quite rightly. And so we're not buying oil from them, and energy prices went through the roof. But then food also has gone up massively as a cause of inflation, largely because Ukraine is the breadbasket of Europe. They exported so much grain. And if you're thinking, well, I don't eat grain, well, how does that affect me? Well, it affects everything which does eat grain. If you look at the price of eggs and chickens, they've gone through the roof because chickens eat grain. And if it costs more to feed a chicken, it costs more to make an egg. So that's where we are now. And what happened at this point is central banks got caught completely off guard because they've had low interest rates, which stimulate growth. Then a massive amount of inflation came out of nowhere, which they seemingly were unprepared for. If they raise interest rates, they reduce growth and potentially cause a recession, which is why everyone was kind of so against it. But they've got to do something because, inflation is ruining people's lives. We injected loads of money into the markets over the last 10 years. None of that went to the man on the street. But inflation hit them the hardest. So central banks had to do something, or at least look like they were doing something. And the way you fight inflation from various economic theories is you reduce demand. Because inflation is either caused by an increase in demand, so people spending more money, or a reduction in supply, so there's less goods to purchase for. And if you've got less amounts of goods but the same amount of money, then there's more money per good, and vice versa for more demand to the same amount of supply. So they've raised interest rates, and inflation after a while has started to fall. I would argue that is because we have supply side inflation, not demand inflation.
Sure.
And that the reduction in supply has already happened, and it's not going to increase. And so we saw remember, inflation isn't a measure of the price level, it's a measure of the change in price level. So we saw the change in price level skyrocket massively and then kind of fall down and fall down and fall down, because there's not much less grain that Ukraine can export. There's not much less oil we can buy from Russia. And now, the position we are in today has three different schools of thought on what could happen. Some people think the inflation genie is never going to be put back in the bottle. And those people I largely disagree with, because again, my view is supply side inflation, which is temporary, rather than demand side inflation, which can have a spiraling effect like the Weimar Republic. The second is that governments around the world are broke. Because remember, we've had all of this debt. Government's been borrowing money like crazy at really low interest rates for 10, 15 years. Essentially, they've become addicted to low-cost debt, and suddenly that's been taken away from them, and we are now going cold turkey on high rates, which is a huge amount of money they have to pay in excess costs just for borrowing this to pay for what they'd pay for in the past. And the third school of thought is that central banks are going to cause a massive collapse in the economy if they start offloading this government debt. So they start selling off these bonds, which they've got this huge balance sheet of. Because remember, they bought a load of bonds. They bought a load of government bonds during quantitative easing at low rates. And everyone for a long time now has been saying they need to reduce their balance sheet. Well, not everyone, but a lot of people. And if they do that, that essentially will mean that you've got a load of suppliers into the bond market, the bond markets fall apart, and governments can't really raise any new debt unless at extortionately high rates, because suddenly their biggest buyer has gone out of the market. Now, I don't agree with pretty much any of those positions. I think inflation is temporary. I think that some governments are broke, Argentina, for instance, but not all. And I don't think that central banks, for a long time, are going to stop the flow of cheap debt. I think that rates are likely to be cut, just because if they don't cut rates in the next year or two, we're going to see governments run out of money. And I am optimistically bullish on long-term growth. Over the next 5 years could be mediocre growth, but it's on an upswing. Because while we do have all of these inflationary pressures, we've got a backdrop of massive deflationary pressures. We have an aging workforce. We have the supply chain being repaired across the world. So the damage which happened to it during COVID is being undone. Right. So long term, I'm very happy to invest. In fact, I've been very happy to invest for the last 2 years. And have been encouraging people to do so quite a lot. And finally, it starts to look like I was right. So that's my very kind of long overview. I could talk about climate change for about the next 20 minutes as a long-term play, but for time, I'll stop.
Well, and I mean, we'll definitely be having you on again, maybe halfway through 2024 and see, how much of your prognosticating has come to fruition here. I want to jump into metals. Obviously, this is a metals-focused podcast here. The last week, as Mark mentioned, has been incredibly positive. The last, month and a half really has been very positive for metals. Gold's up just shy of 11% on the year. Despite a bearish macro environment with rising interest rates, central banks are buying record amounts of gold once again. I'm just curious, what you make of the metals market right now. A lot of people are talking quite bullish, going into 2024 once interest rates start getting cut. I'd love to know your thoughts on metals in general.
Well, I think metals is, I think it depends on the metal. I was always, when I was a stockbroker, interested in the rare earth metal side of things. So stuff like lithium. Vanadium was actually one that I really was interested in about 10 years ago, because there were a number of clean energy companies who were trying to use it as a basis for clean energy storage. But my understanding on the gold is that some of the gains that we've seen recently were actually brought on by a weakening dollar. And really, I think that the market is betting on lower interest rates, but the metal space is always quite a good hedge against emergencies, because at present, at the last month, everyone thinks the market's going to get back on board, everything's going to be rosy. But just in case it doesn't, I think a lot of investors are probably looking out there going, it'd probably be good to have quite a lot of gold just in case things go the other way. I've also seen that I think, as you said, central banks are trying to build their balance sheets of gold. And any broker will tell you that institutional investments in the form of governments or large companies makes a lot of a difference in the markets than individual retail investors.
Sure.
So with the uncertainty that the current market, the current economic forecast presents to a lot of governments, it could be sensible to look at a precious metals investment as a way of just parking some cash in case they need it later.
Right. And I mean, it's a very good point. We've seen a lot of countries, we see BRICS talking about de-dollarization, China talking about de-dollarization. So, that weakening US dollar is definitely bullish for gold prices. And like you said, if these institutions and governments are buying up gold, then it's clearly going to move the market a little bit. So yeah, it's something that we always recommend here, is to have obviously an allocation of your portfolio in precious metals just purely for that hedging purpose. I believe we've got time for one more question, and this is one that I quite enjoy asking people like yourself. It's in regards to technology. We're obviously moving at a breakneck pace right now. We've got electric, autonomous, self-driving vehicles coming. We've got AI being the buzzword of the moment. We've got digital assets and cryptocurrencies that are having, a banner year. Curious from a financial advisor's standpoint, what are your thoughts about the potential around technology, particularly AI and cryptocurrency, 2024 and beyond?
I'll break those down into two categories because my answer differs pretty massively.
Sure.
Well, in general, as an investor, the reason I invest in equities is because I bet on technology. I think technology is the driving innovation behind the human race, but with the driving innovation behind making money. And although you guys probably won't like hearing this, the reason that I've often stayed away from certain precious metals is because I've always viewed that investment as a bet against technology getting better in order to be able to extract more of it from the Earth's core. But when it comes to metals, although I do appreciate you asking me about them, I will say that you guys are definitely the experts, and you guys are the guys I listen to understand the metals market. I'm more focused on the equities, to be completely honest.
Sure.
But going back to the question, AI and crypto, I think artificial intelligence has, like all technology before, a large amount of potential. But similar to the boom in the 2000s, there were companies which, as soon as they added .com to their name, skyrocketing 10 times in value. And also, actually more recently, if we look back in, I think 2020, 2021, I think 2020, you guys have heard of Long Island iced tea, right?
Of course.
Yeah. Well, they changed their name in 2020 to Long Island Blockchain. They still have done nothing with crypto. I just want to put that out there. But their stock price, I think, went up 200%, pretty much tripled overnight. And I think getting caught up in the AI buzzword, the AI fever, can lead to some pretty large overvaluations. I have no doubt, though, over the long term, that an investment across the AI space should yield fruits. But just as they say, when you have a gold rush, don't dig for gold, but sell the shovels. I'm not going to recommend any specific companies. I also just want to say everything I've said so far is a very specific individual opinion and does not reflect the investment outlook of Blacktower. Should have said that at the beginning. If you will humor me, I want to give you my semi-long-winded explanation of what the blockchain is, as a reason as to why I feel a certain way about crypto. It's gonna surprise you when I start. So 500 years ago, there or thereabouts, there were a group of people in Micronesia on the transport, so a big disc, brought it back to the island of Yap. And they were the talk of the town, essentially a big way of flexing money. Having this giant limestone block, some of them, because there are more, as you will see, reached 12 feet in height, was essentially saying, I have enough money to travel 300 kilometers in really scary seas to get this large block and then bring it back, because that's how I roll. And soon other people said, well, I want a limestone block to show how good I am at investing or having money or flex on my neighbors. And so more and more of these were brought back on these terrifyingly long sea journeys. And before you knew it, they were valued in society as a huge, significant indicator of wealth. People started using them to broker marriage deals. People started using them as a way of settling inheritance. You get all the houses, I get the big limestone block because that's what I really want. You could buy boats, houses, whatever you want with them. And before you knew it, they were currency because they could be traded. The trouble is that these are giant limestone blocks. And using them as currency means that you can't really carry them around with you. You've got to leave them in one place. And so the really interesting thing about how well, they were called ray stones or rye stones. I still need to understand the pronunciation, to be honest. The interesting thing about these stones was rather than using one and then giving it to the person that you bought something from, that would be too much effort. So everyone just remembered who owned which stone. And it gets a bit weirder, actually, because one of the stones during a travel back was lost in the ocean. Big stone, fell off the side of a boat, hit the ground, hits the bottom of the ocean floor, and you'd think the stone's lost. But the islanders said, well, now we know, well, it's okay because the stone exists, it's just at the bottom of the floor. So it's still worth something as value. We'll just remember who owns the big stone at the bottom of the floor. So if I want to buy a house and I own the stone at the bottom of the floor, you give me the house, and then everyone just remembers you now own that stone. Right. And that's how the blockchain works, because the way in which transactions occur for these big stones is everyone just remembers who owns which stone. And just like that's how we do transactions over the blockchain, because rather than having a collective knowledge and remembering from individuals about who owns which cryptocurrency or particular cryptocurrency, we have computers do that for us. Nodes on a central database of computers connected with a collective memory of who owns what and which transaction happens where. But that doesn't mean that these cryptocurrencies are innately valuable. Just like giant limestone blocks, their real world use often isn't worth anything. And the problem with cryptocurrency I have is that it's a very unregulated space. I could talk for hours about NFT scams, but there are over 23,000 crypto coins. How many of them have mass adoption now? Very few. Do you know how much it costs to pay for something with a Bitcoin? Just costs in terms of how much energy that you will spend. Any guesses?
I mean, I don't know Bitcoin, but I saw Ethereum transaction fees earlier today were about $40.
Right. Wow. Really? I thought Ethereum would be lower because they switched to proof of stake.
No, the network's been busy, so yeah, they have been higher. Yeah. Because
Bitcoin is much higher than that. Last time I checked was $65, but it's actually, given the fact that Bitcoin prices surged, I'd probably estimate somewhere around the very conservatively $80, but probably above $100 mark for one transaction. So if you are going out and buying a packet of crisps, you're not going to be buying that in Bitcoin. So for a cryptocurrency to be viable, we need to find a crypto coin which has got very low transaction costs, can handle a large amount of transactions. Because, for example, Bitcoin again, which I go to because it's the largest cryptocurrency there is, can only handle a very small amount of transactions on the blockchain at maximum load. There's a cap. And the reason why you need this is because you're not competing with other cryptocurrencies. You're competing with Visa transactions. which are millions or hundreds of thousands of times cheaper, faster, more secure. They're not decentralized, but what is the benefit of centralization if you don't have all of the other stuff?
Sure.
And eventually there'll be a cryptocurrency out there, out of those 23,000, but by the time this happens, maybe 50,000, 100,000, which gets it all right. But that will mean all of your other investments in crypto are probably going to considerably devalue as everyone else finds this coin, which is actually worth something. And on top of that, it's incredibly unregulated. So everyone comes into the market promising these amazing, everyone says to the moon and stuff. We're going to have all of this fantastic technology, which probably doesn't really work that well. And using loads of, rug pull scams, where you get loads of investors think that their money is going to triple overnight, and they have the rug pulled out of them as the people who created it just sell into the open market and essentially just take money from unsuspecting people. So I don't think an investment into crypto is wise for a long time, but especially until it becomes a well-regulated space in which people can't promise you the world and not have to deliver and essentially steal your money.
Very fair. And I mean, maybe I should have prefaced that more along the lines of Bitcoin and Ethereum, as they've separated themselves from the pack. But that can be a conversation for our next meeting, and we definitely want to have you back on.
I can quickly answer those two, though. They're too expensive. I can quickly answer those two. As you said, the cost of transaction is just too expensive. So
sure.
they're non-starters.
Yeah, and as we've just touched on, $40 to $80 fees are pretty egregious when, wanting to buy a bag of chips, as you mentioned. Luke, thank you very much for joining us today. It was really great to have you on the show. We appreciate your time and look forward to having you again soon.
Oh, pleasure to be here. Thanks, guys.
All right, we're going to wrap up our show as we always do with Mark and his Bullion Basics segment. Mark, what do you have for us today?
Yeah, generally, Jeremy, the Bullion Basics kind of focuses on, the ABCs of investing in gold and silver and kind of that long-term outlook. Generally speaking, gold and silver investments are mid to long-term. But I wanted to talk about something a little bit differently today because, it was a good thought. One of our colleagues here at SWP brought it up when we were talking about that price spike on Sunday evening where gold went up almost $100 an ounce. And then it came back down immediately the next morning on the North American markets. And my take was basically what we had is a false news report about an American warship being attacked in the Red Sea. So the initial news says, I think it was the Houthis had used a drone to attack a warship, and that's like huge escalation in the conflict that's occurring in Gaza. And then, later to find out that wasn't accurate, and the price subsided very, very quickly. But the point that I'm making is that these black swan events, whether it be a very short-term black swan event like a warship being attacked, or a very prolonged black swan event like we saw with COVID in 2020 all the way, really through 2022, an event that forced governments to literally shut down entire economies, gold reacts very strongly to these events, whether it be short-term reaction or whether it be this longer-term prolonged event with like subsequent consequences on economic policy and such. So my takeaway here is that two things: the events do happen. You don't have to be a conspiracy theorist, or someone who's reading, Reddit articles all day long to know that these things actually do happen. And secondly, if you want to benefit from them as a gold and silver investor, you need to have that hedge, that safe haven investment as part of your portfolio before the event happens. You don't want to be the guy chasing the news, as a lot of investors who bought gold heavily on Sunday evening when they saw that news article did, only to get wiped out the next morning because all they did is chase the news. They had fear of missing out on that investment opportunity and making a quick dollar. So really, if you position gold in your portfolio as a long-term hedge against black swan events, against some more predictable events, that's where you're going to benefit, not chasing the price based on news. And that's the Bullion Basic for this week, Jeremy.
Thanks for that, Mark. That's all for us today. Thank you to Luke Staden of Blacktower Financial Management for joining us. Thank you to all of you for listening. For more information on precious metals investing, you can always head over to our YouTube channel, Strategic Wealth Preservation on YouTube, or visit our website, www.swpcayman.com. Thank you very much once again for joining us. Stay safe and happy investing.
Thank you for listening to Inside the Vault. the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.